The Fed is pushing assets like the 1970s. So where should we be going now with our money? Well, the Federal Reserve has been creating US dollars at a rate the world has never seen, increasing the money supply by 35% in just the last 12 months. In fact, so much money has been created that they took down the M2 money stock chart, so we can't even monitor it anymore. And they're trying to protect the currency from crashing, but they're sacrificing the bond market, which is much larger and much more dangerous. So in this video, I'm going to break down what they are doing to the US dollar, what they're doing to the bond market, and what the outcome of this is going to be. Now, the big catalyst in the market and what the assets are going to be seeing massive inflows as the Fed continues to try to save the bond markets and the currency at the exact same time. So let's go. All right, now before we dig in, if you're new to the channel, my name is Mark Moss, and I make these videos because I want to change the way you think about money, because almost everything you've learned is wrong. And if you can learn to see and think about these things differently, then you can have more freedom, more options for your life, your family, and your future. Now, if you like these topics, help me, please take one quick second, click on that like button so the algorithm sends it out to more people. And if you're not already subscribed, hit that subscribe button and the bell notification so you're notified every single time I put new videos. All right, let's go. All right, so we're gonna go back right at the beginning. We're talking about something that we talk about quite a bit, and that is dumping dollars. Now, there's a problem going on, and that is that the Federal Reserve has what we are calling a loose policy which is creating an unlimited supply amount of dollars. Now, an unlimited supply amount of dollars, they've basically created, as I talked about, 35% more dollars just in the last year, increasing the money supply. Of course, every time they create one new dollar of debt, it makes each additional dollar that you hold worth less and less and less. So it's these loose policies where, $1.9 trillion in stimulus goes out, and they're already talking about another 2 to 3 trillion, and on and on and on. And what that causes is that nobody wants to hold on to the dollars. It's almost like, a ship is sinking and rats are jumping off as fast as they can. Everyone's trying to get out of the dollar. And of course, it's easy to see this. We have asset bubbles everywhere. All 3 stock indexes, all-time highs. Bitcoin, all-time high. But not just that. Lumber, steel, concrete, houses, of course, but even used cars. You name it, we're seeing prices going up like crazy as everybody is trying to trade out their dollars for anything they can. But most of this is all happening in the scarce assets. All right, now, the more scarce the asset is, the more it's going up. So for example, real estate in the middle of the Midwest in Kansas, for example, isn't going up near as much as beachfront property, in LA or in Miami, something like that. So scarce assets, and gold obviously has been a very scarce asset for 5,000 years. And really, it's all about this store of value. People realize that their dollars are losing value, and so they're trading them. They're always trading those dollars for assets that can hold their value better, that can be worth more, that can buy more later in the future than less like their existing dollars can. All right, now the Fed is committed to keep this game going. Keep this game going at all costs for as long as they can. As a matter of fact, they've committed to keep rates near zero. They have committed to maintain their monthly asset purchase program. So what do I talk about that? Well, we can see here that Jerome Powell, he says that they are going to hold rates to zero through at least 2023. They've gone on to say even more things like that, like they're not even thinking about raising rates. So they're committed to keep those rates down because they cannot tighten the policy. Their back is against the wall. So in addition to not raising rates, they also pledge, the near zero rates, but also to continue to buy bonds. They're continuing to pump money in at the same time because their back is against the wall. We've done several videos on this, so I'm not going to dig in deep. If you want me to dig in deep on that, leave me a comment down below. We can make more videos about that. All right, but I've covered that a lot. But the problem is this rising yield. All right, so this is the problem, and they're kind of stuck between a rock and a hard place. I've made another video talking about their 2 choices that they have, and that kind of explains that a little bit more. And so what we want to do is we want to be watching the treasuries. All right, this is the piece that most people need to be focusing on, and I'm talking about the 10-year and the 30-year yields. All right, so these are the bonds. So when the government wants to take on debt, when a corporation wants to take on debt, they issue a bond, and the yield on that bond is the interest that it pays. Now, like all prices, they're driven by supply and demand, or they should be driven by supply and demand. So as less people want to loan money, then the price goes up. The yield goes up to attract more borrowers. And so that is what we're trying to pay attention to. However, the Fed needs to control those yields so they can influence rates. So let me give you an idea of what's happening with the yields. Now we can see here, this is the 10-year. So the 10-year is probably the most looked at yield, bond yield. The 30 years also. Now what we can see, this is from 1982, so this goes back quite a bit, but you can see how the yield has just been continuing to go down, and all the way here where it actually got to about 0.5% in about August of 2020. Since then, you can kind of see that it's come up just a little bit here to 1.5. So a raise from about 0.5 to 1.5, it's a pretty big jump. However, when you look at it in context of history, when you can see right here, this line is 15% right here. So 15% in 1982. So it's been a downward climb, but we need to keep an eye on this, and I'm going to explain to you why that is in a second. Here's the 10-year, this is the 30-year, and you can basically see the same thing. Here we have 10% right here in 1988, and it's continued to be a downward decline all the way here to about 0.7% right here, and it's up slightly to about 2.8. So while again from a 1% to 2.28 is a pretty big jump, when you look at it in history, it's pretty small. But the problem that we have right now is with all this loose monetary policy we're talking about, all these dollars that are being created, and it's creating inflation worries. And it's those inflation worries that are starting to create the problem when you look at them in context of what these bond yields are doing. So I'm going to break that down and explain to you what is going on. All right, now what the Fed is trying to do is they're trying to repress these rates. They're trying to hold these down. All right, they're trying to force what we call real bond yields below inflation. So what do I mean by that? Well, obviously, if you're trying to borrow money, you want the rates as low as possible, especially when you're the federal government, you have 28 trillion, almost $30 trillion worth of debt. You need to keep that interest rate down. In order to keep the stock market game going, you need to keep the debt down, or I'm sorry, the rates down, so these corporations continue to borrow more and more and more. If the rates go up, the rates that they borrow at, the borrowing gets more expensive, less people can borrow money, less debt's created, and the whole system starts to fall apart. All right, that's the big picture, but that's not what we're talking about today. We're talking about these real bond yields, and they want to keep them below inflation. So what am I talking about? Well, I'm talking about the real yield. The real yield is the Treasury yield, what we just showed, the 1.6, the 2.2, that's the Treasury yield, minus inflation. All right, so inflation is going up, the cost of goods are going up. Let's say, let's take a look at this. So back to this chart, we have the 10-year, it's at 1.6 right now, up from 0.5, so that's pretty big. However, per the Fed data, we can see that inflation is about 2.56 right now. So what do I mean by this? Real yields. Okay, so it's just easy math. We have 2.5 minus, let's say 1.5 gives us a -1. So we're actually negative yielding debt. So we have right now, typically the way it works is when you loan someone money, you expect to get that money back plus interest. They're paying you, all right? What this would mean is that you're actually losing money to loan. So you're losing 2.5% on the inflation, but you're not making it on the yield. Does that make sense? So you're actually at negative yield. So you hear about other European countries and whatnot having negative yielding debt. As a matter of fact, I believe there's about $18 trillion of debt today that's negative yielding. Well, when you look at the inflation rate in the United States and the yield that it's paying out, we're technically in negative yield at that point. And what this means is that at that point, a treasury becomes a liability. So holding a treasury typically would be an asset. What that means is, now, typically retail investors, you and I, we're not holding a lot of treasuries. These are for the institutions, hundreds of billions of dollars, sovereigns, trillions of dollars. They don't put their money in JP Morgan Chase or Bank of America. Instead, they hold bonds, treasury bonds. And so typically that would be an asset. But in this case, it's actually a liability because they're losing money by holding treasuries. And of course, nobody wants to be losing money. And so that is the problem, or maybe the opportunity, depending on which way you look at it. So what's the catch here? Well, the catch is that if the central banks are the only ones that are buying bonds, then their balance sheets are going to be exploding. Because if no one else is going to buy them, that means they are going to have to buy them all. They're going to be the only buyer at the market in order to keep them off the market. On top of that, what we've already seen, I've done a video about this before, is that they'll be forcing banks to actually buy and hold these bonds as well. And they'll do that in order to continue to take these off the market. If nobody's buying them, the rates are going to skyrocket, which of course we can't afford. So in order to hedge against this, we're seeing institutions and funds buy gold and buy Bitcoin, all right? Buy other forms. Now, of course, some funds may be buying stocks. Everyone's trying to get into some sort of asset to keep up with this. They know that treasuries are not the place to park their money. And so they're hedging it, buying gold, buying Bitcoin. Now, one is really more retail and one is more institutional. So what do I mean by that? We are seeing a massive trend right now with retail investors, you and I, family offices, small funds, etc., starting to hedge with Bitcoin. We're starting to see that. All right. However, the big institutional funds, the hundreds of billions, the trillions of dollars, even the sovereigns, the central banks, they're not buying Bitcoin, not yet. They are still buying gold. As a matter of fact, they're buying more gold today than any time in history, because why would I hold a treasury that has risk, counterparty risk they could default on, and I'm losing money, guaranteed losing money just to hold it? Why would I do that when I could just be holding gold? All right, now, when we look back through history and we look at the real rates, again, remember, not the rate they're paying, the real rate, which is the rate minus inflation. When we look at that, we can see gold's performance compared to what these negative real yields have been. Now, in this chart right here, let me pull it up a little bit bigger. Now the chart is actually inverted. So what does this actually mean? Well, what we're seeing is that in the red line is the 30-year, the yield less CPI, so that's the real yield. The blue line here is the price of gold. And so when the real yields are spiking, or in this case it's inverted, so they're dropping, the price of gold goes up with it. And you can see how closely correlated this price is. So it's the real yield that's really driving this gold price. Now we can see from 2015 to 2020, both of these have been going straight up right here. Now we can see some spikes here in the 70s, obviously this big one. We had this big bull gold market from about 2000 to 2015. You can see both of these went up in unison. They both kind of dropped into here, but you can see both of them going up at the same time right here, because inflation's going up, bond yields are going down, means real yields are going down, which is pushing the price of gold up higher and higher and higher. Now, like I said, this is the dilemma. They're stuck between a rock and a hard place here, the Fed is, right? They can't let yields go up. They can't let bond yields go up because then borrowing's too expensive. They have $28 trillion of debt. They need corporations to borrow. So they can't let the bonds go up. However, if they do that, if they do let the bonds go up, they can't service the debt. We could see the stock and the bond markets start to deflate. The other problem, though, is that with all the money printing, we're seeing CPI, Consumer Price Index, that's the inflation metric, it's starting to go up, starting to spike, as I showed you in this other chart. So the dilemma is they're fighting a battle they can't win. And that's really the problem. They're stuck in between a rock and a hard place. And so based off of this, I think that we can easily see gold rise to over $2,300. So yes, I'm a big Bitcoin bull and I still believe in that. But like I said, that's really kind of more driven by the retail investors, you and I, maybe some of the small funds. But the sovereigns, the institutions are buying gold. Now, a $500 price in gold from here about $1750 up to $2,300 could push gold miners up 100, 200, even 300%. So let's take a look at that. So triple digit winners are always the goal, right? We let our winners run long, we cut our losers short. I'm always entering, trying to look for asymmetric upside, right? More upside than downside. And so when we're aiming for triple digit winners, that's the way that we get there. Now, mining can be a pretty tough game, all right? Buying the price of gold, like I said, we can go from $1,700 to $2,300, all right? Adding $500, it's not that big of a deal. But that's an asymmetric move on the miners, because if gold goes up $500 an ounce and they have 1 million ounces in the ground, that's a $5 million swing. You kind of get how that goes. But it can be tough, right? But because of that return on the price of gold, it makes it a very attractive investment for us. And now is the time to get in. Now, why do I say that? Well, A couple of reasons. First off, we have been in a downtrend for about 5 or 6 months now. Since about August of 2020, gold miners have been trending down. Because of that, we're starting to get to the point where it's hated and it's cheap. So we've been in a 5 or 6 month downtrend and people are starting to give up on it. People are saying, if the government can print trillions and trillions and trillions of dollars and the price of gold is still going down, then I'm out. Why would I even hold it anymore? So it's been hated, all right, and it's cheap. However, things are changing. So the real yield is what's changing. Inflation is spiking big time, and now the bond yields are kind of leveling off, which is starting to give us that very, very negative real yield. And that's the thing that people were missing. And so right now we've been seeing gold back on that uptrend, all right? We don't ever want to try to catch a falling knife. We want to wait until it bounces and it starts to make an uptrend. That's the time to do it. Now, the way that we want to look into gold miners, like I said, investing in gold miners can be very, very difficult. I've done a few videos on these before, and if you've invested in some of the picks that I've outlined in some of these videos, you could have done very, very well if you learn how to take profits when the prices are going up. Now, the first thing that I always do, and I've talked about in other videos, is always look at the team. All right, now, looking at this can be very difficult. There's lots of metrics to understand. So what I do in order to compress that time is I look for the right team. If I find a good team who's had a massive track record, I would assume that they've already done a lot of work before they join that company, so it shortens my gap. And there's a company, Aris Gold, that I'm taking a look at right now, Aris Gold, and they have an all-star team. As a matter of fact, Neil Woodyer, he's the founder and CEO, and he has an incredible track record. He's the founder CEO of Lee Gold and Endeavor Mining, which are some of the largest mining operations in West Africa. And he's been able to kind of repeat this shareholder value over and over and over. And so he has a track record of success. And somebody like that that has a good track record of success isn't going to go to a loser company. Like I said, there's a winning track record. Now you might recognize some of these names right here. Gold Corp, Yamuna Gold, Wheaton Precious Metals, one of the largest companies in the industry, Grand Columbia Gold, Lee Gold, Endeavor Mining. And so they've taken some of the biggest and some of the best companies in the industry, and they've taken all of those, that combined experience, brought some of the team members from each of that to create, back to that slide that I was showing you before, which is an all-star team. All right, now on top of adding the right team, they also have some of the best backing. Now, when I invest into private deals, a lot of times I invest into technologies and things like that that I don't know a lot. And so what I do is when I go in to evaluate these deals, I want to make sure that I'm not the smartest person there. I want to make sure that other people that are smarter than me are already bought in, because if they've been convinced, then it's easier to convince me. And that's exactly what we can see here, that Aris Gold has received massive amounts of backing, and not just from a bunch of nobodies who don't know anything, but some of the biggest players. As a matter of fact, Aris Gold has $272 million of cash and funding that's been committed to go ahead and build out their mines. And we have Wheaton Precious Metals, again, who's one of the largest players in the entire gold mining space. They've committed $110 million of funding. Now, another thing that I really like here, and I always look at in any company, is the amount of stock that's held by the company. Now you can see right here that 8.5% of this stock is held by the Aris Gold board and management, which is really, really good. And then we can see a huge chunk right here, 44% is held by Grand Columbia, which is another really big gold mining company that I've talked about in the past, and we were able to do pretty good with that one as well. But seeing that Wheaton Precious Metals, like I said, has backed this, I'm not the smartest person in the room. We have big companies, very successful companies that are putting up lots of capital in this. Now, getting capital is one thing. Now, if I'm investing into a company, I always want to know, what are you doing with the funds? That's always a key piece. And in this case, they have two different mines, the Marmato mine and the Juby mine, that they're going to go into, they're investing into right now. Now, currently the Marmato mine is already producing 24,000 ounces of gold a year. So this is not some tiny exploration play. We're not crossing our fingers and hopefully they go find gold. As a matter of fact, like I said, they're already producing over 24,000 ounces of gold per year. And with the funding that they've already gotten, they can increase up to 165,000 ounces by the year 2024. So we're already buying into production, and with the money, the use of proceeds, they're going to be able to expand that pretty quickly. Now, what I like about this project though is because they're already producing gold, we have an idea of how much it costs for them to produce the gold. And based off of this, they could be one of the lowest price producers in the industry. It looks like right here, they're projecting to have about an $880 ounce per ounce of gold. That's how much it would cost them to get out of the ground. So if gold's 2,000 bucks an ounce and they're paying 880, call it 900, there's about $1,100 of profit off of every single ounce. Now, what I like about that is, let's say that gold were to drop to 1,500 or even back down to 1,200, well, they're still wildly profitable even at that price level. Now, I don't think that's going to be the case. I believe gold will be going up to 2,000, 2,300 and even higher, but having that low $880 price really protects us as investors. Now, we always want to hope for the best, but we want to plan for the worst, and having that low price is really something that would help us out there. Now, I've thrown around a lot of numbers, and we don't know. Of course, I've said over and over, if you watch my videos, that it would all be so much easier if I only had a crystal ball. But of course I don't have a crystal ball. So what is going to happen with gold is, like I said, really anybody's guess. However, we have some pretty telling signs. We know that the Feds are not raising rates, right? They've told us that. We know that they're printing trillions of more dollars, because they've told us that. So what we want to watch is these real rates continuing to trend negative. Will they continue to trend negative? Well, as long as they keep printing currency and holding the yield down, we're going to see real rates continue to trend negative. Now, like I said, the wild deficits, we're spending double what we're bringing in on tax revenues, the money printing as we call it, the 30-year treasury, as they're trying to transition that and control that yield, we're going to continue to see this play out. Now, like I said, usually plain treasuries would be a portfolio hedge. It's a way to hedge a giant portfolio, but when they're negative yielding, it's not an asset anymore. Instead, it's dragging your portfolio down. And when you're an institution, when you're a central bank, when you're a sovereign with hundreds of billions or trillions of dollars, you don't want that negative yielding. You're looking to move that as fast as you can. And like I said, they're looking for gold for protection. Now, retail likes Bitcoin. We're starting to see a lot of that picking up. However, we're talking about hundreds of billions and trillions of dollars moving. And so the point is that we want to be ready. These are not the types of moves that you want to jump in after. Now, like I said earlier, we never want to try to catch a falling knife. We don't want to time it. And so gold has been in a downtrend for 5 or 6 months. But that is changing right now. Gold is bouncing, and that is because inflation is starting to spike. So because the yields had dropped down to 0.5 and they went back up to 1.6, as it went from 0 to 1.6, gold started coming down. But now that inflation is spiking, it's turned negative and it's starting to be gold, and we're starting to see gold bullion get the favor as interest rates continue to crush. Now, like I said, I don't have a crystal ball. I don't know the future, but this is what I'm seeing. Let me know what you think. Leave me a comment down below. Let me know if you're seeing the same thing. All right. Now, as always, give me a thumbs up on this video, because you know I'm working hard putting all this content together for you. If you don't like it, I guess give me a thumbs down either way, but leave me a comment and let me know. Also, if you ask any questions on this video, I'm grabbing your questions and I'm answering them on my new Market Disruptors channel. If I answer your question on the new channel, I'll be sending you $25 in Bitcoin. Of course, the catch is you have to go watch the video and let me know that I answered your question. If you do, like I said, leave a comment, we'll send you that $25. That's what I got for you today, all right? To your success. I'm out.